Yeah, maybe I wasn't feeling well that day. My apologies also. I've decided on reflection not to speak in Norwegian. So we'll, you'll have to bear with me here. So there we are. Just to be clear, things are terrible. But things may appear to be getting a bit less terrible. And that's the optimism, if you like. And I want to talk about several developments that are taking place. Basically, it's a bit of only a little bit about the United States. It's more like a tour, and most of what I want to say is, I think, actually about Europe, which is in many ways the most interesting place. But then about Japan, anyway. But let me actually start out with that situation. The general picture for most of the advanced world is that 2014 looks better than 2013. And in some ways, 2013 looked better than 2012, not because things are good, but because things which are still objectively very bad are not as bad as they were, and because, not because policies are good, but because policies which are objectively quite bad are not as bad as they were. I think that's the general description. Actually, one way to, a metaphor I've used some is that if you think of a person who for some reason keeps on hitting himself in the head with a baseball bat, if eventually the person stops hitting himself on the head with the baseball bat, he will start to feel better. And that is, roughly speaking, a description of where we are in terms of economic policy right now. Just a quick survey. What changed over the course of the past year? And if we take the advanced world, the United States, in many ways, 2013 was a lot like 2012, but the outlook on the budget, at least the official outlook, which was excessively pessimistic, has changed quite a lot. And that has, in a kind of half-hearted way, led, again, to policy improving in the sense that we're no longer doing quite as much self-punishment. Europe is really interesting. Something quite dramatic in a positive direction has happened, although it's still a terrible situation overall. And then Japan, which is, all right, we'll get there. Let me just tell you about the US situation. 2013 was really a year of self-punishment for the United States. If you follow the kinds of things that I and other critical Anglo-Saxon economists have had to say about the euro, we go on a lot about the damage done by austerity policies in Europe. But in 2013, the United States, not out of any clear-cut strategy, but just as a matter of political default, followed quite strong fiscal austerity. Federal cutbacks, a rise in taxes, particularly payroll taxes, so taxes on workers, the sharp cuts in federal discretionary spending, and some continuing cutbacks at the state and local level meant that in 2013, actually, the tightening of fiscal policy was more dramatic in the United States than it was in Europe. Probably the federal actions alone shaved at least 1.5 percentage points of growth. If you look at what was happening at lower levels of government, you'd want to add to that. So what could have been a year of quite strong recovery was instead a year of continuing limping recovery with an improvement in unemployment, which is primarily about a reduction in the number of people seeking work rather than an improvement in the employed share of the population. However, over the course of that, it became pretty much undeniable that the deficit panic of the last few years no longer made sense. So these are projections out to a decade of the federal ratio of debt to GDP. The 2012 prediction is you don't want to know, but it's the alternative fiscal scenario of the Congressional Budget Office, which assumed maintenance of all of the Bush tax cuts, assumed that the sequester would go away. The 2013 is the most recent forecast, which takes into account the fact that we did not preserve all of those tax cuts, that we are in fact having very sharp restraint on discretionary spending. And the result of all of that is that we are looking now at essentially stable, not a sharp decline, but essentially a stable debt outlook, looking ahead a decade. So if you are, it's not, you can say, oh, well, we should be doing better than that. But the idea that we face any kind of fiscal crisis in the United States is now very hard to justify. In fact, you can even carry out these projections 25 years, well into retirement of the entire baby boomer generation and so on. And they're worse, but we're still talking only about 100% of GDP. So the fiscal crisis has become a very difficult talking point to maintain. In a rational world, that would say maybe people would actually deliberately reconsider policy and say maybe we should be putting priority on job creation, not on the deficit. It's not a rational world, and certainly Washington is not a rational world. However, it does mean that the pressure on the budget has greatly diminished. And as a result, we're not going to be seeing a lot of fiscal drag. Hardly any next year, hardly any further tightening. Meanwhile, housing, we've built very few houses in the United States since 2006. So we actually have a shortfall of housing. So the housing market is starting to recover. Household debt has fallen significantly relative to income. So the ingredients are in place for significant growth in the United States. It's not because we're doing anything smart, but because we aren't doing the stupid things quite as intensely as we were. Much the same, but with additional, is true of Europe. And so this is in many ways, well, the two most interesting developments have been in Europe and in Japan. We're seeing a lot of moderately good news in Europe recently. We see most of it is financial. So we're seeing Ireland exiting the IMF program. We see that borrowing costs have dropped. You might think that that's because the debt problem that has been so much the focus in Europe has been greatly reduced. What this picture shows is that's not actually quite right. So I'm looking at the on the horizontal axis the ratio of debt to GDP for Euro area countries, and on the vertical axis the 10-year interest rate, with the pigs, the gypsy economies, whatever you want to use for the group of troubled debtors. They showing them, and the blue dots are the height of the crisis, November 2011. The red dots are as of this September. Not much has changed there. Debt burdens are up pretty much all across Europe. None of the troubled debtors has yet managed to bring down its debt or even actually stabilize it. Even though they've had a lot of fiscal austerity, they're still running, for the most part, still running deficits, and the denominator has shrunk because of shrinking GDP, deflation or close to deflation. You end up with the debt ratio rising. But interest rates have come down dramatically. And so what you see, you can see it in the picture here, is a kind of flattening. If you were to fit a line through the blue dots, it would be much steeper than a line through the red dots. It's as if the markets aren't as worried by debt as they were before, which is obviously a very good thing, and it's a good thing in multiple ways. Why did that happen? Why take Italy. Why is Italy able to borrow so much more cheaply? Or Spain, not quite as dramatic. Even Greece. Why are troubled European countries able to borrow much more cheaply than they were in 2011? And the answer, well, there are two possible answers, both of which probably have some truth to it. The biggest answer, I would argue, can be said in two words, which is Mario Draghi. If you looked at what was going on during the acute phase of the euro crisis, there was evidently a lot of fear of death spirals, of doom loops, the fear that a shortage of liquidity would lead to soaring interest rates, falling bond prices, collapsing banks, further crisis, rising government interest burdens that you just have a kind of implosion, almost through self-fulfilling prophecy. What you needed to break that was the assurance that somebody would step in with cash. And that somebody could not be national authorities who didn't have the cash. What happened was that through a series of moves, the European Central Bank stepped up to that role, or at least conveyed the impression that it was willing to step up to that role. And so first there was the LTRO, which was, we will not lend money to governments. However, we will lend unlimited amounts to banks with sovereign debt as collateral, which was a backdoor way of doing much the same thing. And then there was the whatever it takes, the famous statement by Draghi that the ECB would in fact do whatever it took, followed by the statement in principle that it would do outright monetary transactions, that it would in fact buy sovereign debt if necessary. It hasn't actually had to do that. And God help us if it comes to the point where it's really necessary and it turns out that they are not in fact willing to do that. But what we have seen is a perception on the part of the market that there is now a lender of last resort for sovereigns within Europe. As many of us would say, that's actually the ECB finally doing its job. Whatever your views on the appropriateness, it's had obviously I would argue that it's the main factor. If you look at the detailed timing, you see that the big drops in interest rates come when the ECB makes strong statements about its willingness to do the job. What this does is it positively transforms the outlook. At a 7% interest rate, the debt dynamics for Italy are impossible. There's just no way that you can make it work. They would have to run an enormous primary surplus in order to avoid having a spiraling upward debt. At a 4.5% interest rate, it's very different. Then you're talking about something that is much more feasible. So that has been a positive transformation. Now you could also argue that there's a political element here, which is that the fear that radicalized politicians in debtor countries would just say, oh, the hell with this, drop out of the euro and default on their debts, has greatly diminished. And it's true. I've been surprised by the political resilience of the euro, even during the worst of times. The willingness of the European political class to suffer through incredible amounts of pain in order to preserve, in order to hang on to that currency. And that, again, is a reason for interest rates to fall. Whether or not you like it, whether or not you think that's appropriate, whether or not you think that the euro is in fact a good idea, the fact of the matter is it's all made the situation substantially more tolerable. Lower interest rates, end of the acute crisis, just a general calming of the European situation. That's not the only thing it does. It also is effectively substantial easing of monetary policy. It's funny that very few people have made this point, but if you look at what's actually happened, this is an average of long-term interest rates across the euro area. So if you look at German interest rates, 10-year rates, they haven't moved very much. But if you look at the average, it's fallen a lot. And the reason is that the Southern European rates have fallen greatly, which in effect means that monetary policy has gotten much easier across Europe. Again, that's got to be a positive thing. So it's really not too surprising that we're now starting to see that there are signs of at least some economic recovery, that we're starting to see the latest survey data from Spain, for example, come in suggesting that the worst may be behind us. It's still a terrible situation. If you wanted to, think about what someone would have said if in 2007 you had said, okay, here's what the situation is going to be at the end of 2013. We're going to have 13% unemployment in Ireland. We're going to have 27% unemployment in Spain. They would have first said, you're crazy. Things couldn't possibly be that bad. And they would have said, well, in that case, surely there'd be everyone would acknowledge that the policies being followed were a disaster. In fact, that people are not acknowledging that. In fact, because things are getting slightly better, or at least not getting worse as quickly as they were, there's some sense that there's a lot of self-justification. But in any case, we're seeing hints of recovery in the Eurozone. And it's conceivable that we'll just basically, at enormous cost, but in the end, Europe will make its way through. On the other hand, there is growing reason to believe that this is by no means over. And in fact, that the problems that we face both in the United States and in Europe are much deeper than simply the fact that we had a severe financial crisis and have had a slow recovery. And this brings me to the catchphrase for following economic discussions, the catchphrase of the last several months, which is secular stagnation, which is a mysterious sounding phrase, but it's a pretty clear view. It has been expressed by a number of people, but it became got a lot of attention when Larry Summers spoke about it at an IMF conference. And I have to say I was extremely annoyed at Summers because I had actually written thoughts along the same lines. But Larry did a much better job both of thinking it through in a clear way and of stating it effectively than I had done. So I was quite annoyed because I had written some kind of murky, incomprehensible stuff, and then Larry goes and does it right. But in any case, it's a quite strong case. Let me make that case for the United States and for Europe. The story about secular stagnation runs as follows. Look back at least 15 years, maybe 20. Look at the advanced Western economies. Over that period, we've had several major financial bubbles. Actually, huge ones, right? We've had, certainly in terms of value, but maybe even in percentage terms, it's arguable that the two largest bubbles in the history of the world were the technology bubble of the late 90s and then the housing bubble of the mid-2000s. Those were huge increases in perceived wealth. They both led to large increases in investment spending. The tech bubble produced about 2 percentage points of extra of GDP in business investment, with massive investments in telecommunications that then ended up producing a lot of fiber that sat unused for a long time. Then the housing bubble led to, in the United States, about 3 points of GDP extra of residential investment that ended up producing a lot of unsellable houses, and a little bit less in Europe, but in the same ballpark. So huge bubbles, which some people look at and they say, well, that means that monetary policy was too loose. Actually, I'm sorry, back a second. On the European, there's also what I would call the Euro bubble in general, which is tied in with the housing bubble. But the belief that Greece was as safe as Germany led to massive flows of capital into Southern Europe and large expansion. So that was, in a way, a bubble overlaid on the bubble in real estate. So some people look at that and say, well, monetary policy was too loose because obviously it was fomenting all of these bubbles. But then you say, well, wait, if monetary policy was too loose, then that should mean inflation. But we did not see an acceleration in inflation. Over the 15 or 20-year period, what you saw was, in fact, inflation coming down, despite what were, in fact, pretty low interest rates on average. What that suggests is that we have an economy which is chronically short of demand. It is, in a way, chronically depressed, but it's a little bit manic depressive. So it has intervals when we are having bubbles, and then we're fairly prosperous, but not hugely so. And then the mania goes away, and we plunge into depression. But if you like, the average state is of being moderately depressed, which is divided between periods of being only okay, which is periods when we have large unsustainable bubbles, and periods of being very depressed, like the one we've been living through for the past few years. very hard to argue, very hard to avoid, at least as far as I can tell on the logic of it, the notion that we have had a persistent shortfall of demand. Now, the normal thing you do if you have a shortfall of demand is you cut interest rates so as to spur investment. But that has two problems. One is that it does tend to make these bubbles happen. The other is zero. You can't cut short-term interest rates below zero. And we have been, people used to say that the idea of being up against the zero interest rate, of facing the zero lower bound, of being in a liquidity trap was something that was going to be very rare. Maybe it could happen conceivably, although some people denied that it was even possible, but certainly it wasn't going to happen very often. Well, that rare, inconceivable condition has actually been the world we've been living in for more than 5 years. At this point, if we start to take the long view, we see that extended periods of zero interest rates can happen. That in Japan, it's been their condition for 15 years. And now that doesn't look that different. Now the United States and Western Europe are both in a similar position. What do you do if that is your problem? Oh, sorry, why might that be happening? That's an interesting question. We can talk about a number of different reasons. I would generally argue that the best story out there would lay a lot of stress on demography. If you ask what are the things that sustain investment? One answer is investment responds a lot to expectations of future growth. And over the long term, one major component of future growth is in fact growth in the working age population. Here we are now with working age population growth dropping off very sharply all through the West, thanks to low fertility rates and the fact that the post-war generation is now leaving the labor force instead of entering it. That's going to have a depressing effect on investment, other things equal. You can argue also that the absence of really dramatic technological developments of the kind that would generate a lot of investment is also important. It's all very well to have tablets and smartphones and the other things we're doing, but they actually don't lead to a large amount of fixed investment. They don't employ a lot of people. And so we may be lacking the kinds of developments that would be driving investment. The demographic issue is something which is really hitting now in the United States and in Western Europe. It hit in Japan some time ago. And so in many ways, the Japanese story has now come to the West. And that would be your secular stagnation point of view. What should we be doing? Beg your pardon. Sorry about that. What should we be doing about that if that's the kind of world we're living in? Well, the answer is that you need to have lower real interest rates. You can't lower the nominal interest rate, but if you can have expected inflation, then the real interest rate can be lower. And prima facie, the biggest single thing that you would conclude from secular stagnation is that you certainly need to maintain the rates of inflation that we've had in the recent past. Deflation is really disastrous, as we've seen in Japan, and quite possibly you want a higher rate of inflation. You also could argue for other things as well. You could argue that we need more public investment. You can argue that we need changes in the tax structure and so on. But on the monetary side, inflation would be something that you really, really need some of. This is where we start to get concerned. So if we look at Europe, this is, I think, actually the most important measure. As you know, there are multiple measures of inflation. Headline inflation is affected a lot by commodity prices. Core inflation, not so much. But in many ways, labor costs is the key here. Europe really needs a certain amount of overall labor cost inflation. And it needs it for two reasons, actually. One of which is specifically European. Because we came into the European crisis with labor costs clearly too high in Southern Europe, needing to be adjusted downward relative to Northern Europe, it's a lot easier to do that by having German wages rise than by having Spanish wages fall. We've seen overwhelming confirmation that it's very hard to get cuts in wages. And furthermore, if it's anything that's achieved through deflation makes the debt problems worse. So you really want rising wages in the European core, mainly Germany, rather than falling wages in the periphery, which means you want reasonably strong overall wage growth. And so it's quite alarming that wage growth overall has been falling. Sometimes people say, well, are we going to have deflation? I don't care. 0 is not an important number here. It's not that when you cross over the 0 line, something terrible happens. As you fall, things get worse. And so this is a real problem. The United States actually looks similar. Now, we don't have that same problem of adjustment, but we still have the problem of 0 lower bound. And so this disinflation, heading towards deflation, but it doesn't matter. This falling rates of inflation is a big problem, both in the United States and in Europe. It is, I don't know what you want to call it, the Japanification of the West. And we are very much on the path towards Japanese-style prolonged economic problems. Well, sometimes people say, could the things be as bad in the United States as they were in Japan? Actually, Japan, things were never as bad in Japan as they have been the past few years in the United States. Right? They never had the mass unemployment. They never had the kind of suffering we had. And in many ways, their policies were better. They never had the kind of destructive fiscal austerity. What they did have was, of course, continuous deficits, rising debt ratios, but they haven't seemed to pay any price for that. They continue to be able to borrow cheaply. So you could actually argue that Japan is not so... Japan used to be a cautionary tale. Now it almost looks like a role model, but obviously not a good situation, just less bad than it used to be. Which brings me to my last part of the world. If what we're worried about is the Japanification of the West, then we might want to ask, how are they doing in Japan? And that's a really interesting story. If you had said to me that, look around the G7, which country is going to have the most interesting, most aggressive, most intellectually daring policies, and that the answer would be Japan, 3 or 4 years ago, I think everyone would have said, you're crazy. The Japanese never change, nothing ever happens. The Bank of Japan has no initiative. They just sit. But the Japanese went along and actually they elected Shinzo Abe, who by all accounts, all the predictions about what he would do are that he was basically a machine politician who would do nothing interesting and change nothing. Turns out that, what do we know? The Japanese have, in fact, had a significant change in policy. We don't know if it'll work yet, but they really have changed policy much more dramatically than anyone imagined possible. What they've done, they're the 3 arrows of Abenomics. One arrow is monetary, essentially an assurance by the Bank of Japan that it's going to do whatever it takes to get inflation up to 2%. One arrow is fiscal policy, stimulus. Third arrow is structural reform. I don't believe in the third arrow, really. Partly because I'm not sure that they'll really do it. Partly because I'm not sure it matters that much. Everyone's for structural reform. How could you not be for structural reform? But it actually rarely delivers the results that are claimed for it. The second arrow, the fiscal policy, unfortunately, they're about to raise consumption taxes, which will offset a lot of that. So mostly it's monetary. And that's a gratifying channels of intellectual influence. The Japanese are doing what I told them to do. Unfortunately, I told them to do it 15 years ago, and they finally got around to it now. But they are, in fact, and what Ben Bernanke told them to do in 13 years ago. So they're finally doing it. Very difficult thing to do because you're trying mostly to do policy through talk. Interest rate is 0. Quantitative easing by itself doesn't really do very much, we don't think. It's mostly about trying to convince people that you will keep interest rates low for a long time, that you'll just keep on pushing until inflation is up. It's had some large effects. So this is the real inflation-adjusted Japanese exchange rate against major trading partners. And it's a really big deal. That's a 20% real depreciation. That's a large thing. So they have actually, so far, the biggest sheer undeniable effect has been a large fall in the value of the yen. Of course, also, if I understood the labeling on the charts in the previous talk, it also large rise in the stock market. But the exchange rate is the thing that you can see right away, which makes a big difference to the competitiveness of Japanese firms. Have they managed to raise the expected rate of inflation? That's a hard question to answer because you don't have very good measures of expected inflation in Japan, and it's technical and so on. But basically, they have an inflation protected. They have an index bond market, but it's very thin. It's just not reliable. You have to back out estimates other ways. I posted on this on my blog if anybody wants to look at it. This is an attempt to back out an estimate of expected inflation. Never mind. Using the U.S. TIPS market and the real exchange rate and some assumptions, not to be taken too seriously. As I'm not sure that peak and decline is real, but it does look as if there's been a substantial increase in expected inflation in Japan. So in effect, so far Japan has managed to get significant headway on monetary policy. And we should hope very much that it succeeds, because we are all effectively turning Japanese at this point. So it's very important to know whether what Japan is doing is in fact sufficient to turn this thing around. It's not so much in their case about fighting unemployment, which has never been very high in Japan. It's not even that much about boosting output, although that is an issue. But in their case, the fiscal sustainability crucially requires that they get out of deflation. And at least at the moment, it looks as if this experimental policy is changing, is moving things in the right direction. So where does that leave us in the advanced world? As I say, I think the outlook is a lot better now than it appeared to be, let us say, 18 months ago. We actually have signs of real recovery taking hold in the United States, signs that the terrible situation in Europe is getting marginally better, signs that Japan, after all of these years, is finally getting its act together. But it's fragile. And it looks like we have deeper problems than we realized. That we have economies that in a way want, in quotation marks, want to be depressed. And it requires good policy on a sustained basis to avoid that outcome. So as long as we have smart, reasonable, forward-looking government officials in all of the major countries, everything will be fine. Since we don't, I don't know, but we can be hopeful. And it's, as I said, maybe I'm not feeling well, but I actually am feeling, relative to the way I felt for most of the past few years, relatively optimistic about the United States, even about Europe, and especially, amazingly, about Japan. I think with that, we can turn to questions. Thank you.
Thank you, Professor. We have quite a few questions for you. I even found one on Twitter, but I think this is someone in another. There's another conference also going on in Oslo today.
Oh, okay.
And this is our former, actually, Minister of Foreign Affairs, and he's probably at the other conference looking at this one on his mobile phone.
Ah, yes.
Because he says, Krugman, does the U.S. and Europe have a chronically weak demand side, even with interest rates close to zero?
Well, yes, I mean, that's clear. That's the secular stagnation argument. I completely forgot to talk about the Nordic region. So
I have some questions about
let's do that. So let's do that in the Q&A. So
you have also mentioned the impact of years that end with a 3. And I guess a lot of people here are curious on what about years that ends with a 4?
Yes. Well, I think that is what I believe that we're looking at. Probably U.S. growth of greater than 3 for 2014. just on the grounds that the private sector appears to have some momentum and that we're pulling back. We have basically ended the federal fiscal austerity. So that's where most forecasts now are, in the 3 to 4% range for the U.S., and that does look reasonable. Europe, I think we do see positive growth now. Europe is and maybe better than a little bit. Not, I think, as good as the United States, but we actually do see a return to growth in the long-suffering countries of Southern Europe, again, mainly because austerity, although it's still there, is not intensifying anymore, and also because, sorry, more jargon phrases, internal devaluation has been a very slow process, very painful, but it is happening. Bit by bit, you're grinding down labor costs in Southern Europe, while labor costs are rising in Northern Europe, and so you do see an improvement in exports. So very slowly, right? This is in the long run, if you can stick to these policies, they will work. This is, of course, in the long run, we're all dead, but that may not take quite that long. And so we are seeing finally some, the natural tendencies of economies to recover, given a long enough time, it's now been 5 years, are starting to show themselves.
There is a question also here about the money printing. And the increased money printing hasn't really led to inflation. And what are your thoughts on that? Will they stop printing the money in time to avoid inflation?
I hope not. No, I think you actually need to be careful here. Right now, we do not want the Fed or the ECB or the Bank of Japan to pull back before we have definitely restored at least a 2% inflation target of the past. And there's a really strong case that that target should be higher, that it should be 3 or 4, particularly given the chronically weak demand. So we don't want them to step on the brakes too soon. As for the risk that they will allow things to really spiral out of control, that's very, very unlikely. Things to say about that. If you look at, take the Federal Reserve, where I know the situation better. People look at the size of the Federal Reserve's balance sheet, and they say, oh, if that just sits there, right now it just sits there. Clearly, it has not been inflationary. But if all that gets converted into an expansion of lending, once the economy is recovering, it'll be wildly inflationary. There's absolutely no reason to think that the Fed will allow that to happen. They will shrink the balance sheet, or they actually have, this has been quite important, they've established the principle of interest on excess reserves. So if people say, well, how can they sell off all those bonds in the short term? They don't have to. They can sterilize the impact of all of that, those bank reserves on demand, simply by raising the interest rate they pay on those reserves. So the Fed has the tools to prevent any inflationary explosion, and they have clearly the inclination. And so we have a new Fed chairperson, I guess, and who is a dove, who's been very expansionary, but actually Janet Yellen, if you look at her track record, has also been quite strong in saying we mustn't allow inflation to get out of control. So I see no reason at all to think that that's something to be worried about.
And the money is sitting there also in the banks, and maybe also so in a lot of the companies. And the money is sitting there. Do you think is it because of lack of opportunities, investment opportunities?
Yeah. If you look, investment, business investment, non-residential fixed investment in the United States, as a share of GDP is a little bit depressed, but not very much. It's not that far below historical norms, and you can attribute the extent to which it's depressed by the fact that we still have a depressed economy with excess capacity. It's nothing really surprising about it. So if it looks like there's an awful lot of money sitting there, that's partly because profits have been so high. So, but the investment is not very, if anything, investment has been stronger than you would expect given the general state of the economy. Residential investment is still very depressed, but that's a combination of overbuilding, that's no longer so relevant, but also household debt. So households having been badly burned and many of them still being underwater, people who bought houses still underwater, is going to keep residential investment weak. But no, there's nothing really mysterious about what's going on there.
Another mystery question, perhaps. Where will the next bubble come in the capital markets?
Wow. Well,
it's more of a mystery question.
That's right. Well, the question is always what's a bubble now? And that's, I'll tell you, there's a new indicator that I've learned about, which suggests that we don't have a really serious bubble problem. So the economic indicator that I'd always had this informally in mind, but anyway, it turns out that looking at the viewership of CNBC, the number of people watching CNBC is a pretty good indicator of bubbles, and it's way down. Actually, it's quite astonishing. Apparently, the number of people watching CNBC in an average day is something like 38,000. It's unbelievably small. So if nobody, see, I knew that the great stock bubble of the late 90s. The way I knew that was you would go into bars, and instead of sports on the TV, they'd have CNBC. So now it's back to sports. So that's an indication that we probably are not in a bubble psychology universe right now.
So we should follow the number of viewers on CNBC.
Definitely, it's a really good indicator. It's a little bit like, you used to have to do things like skirt length and so on, but
yeah,
those are and luxury purchases. But those are no longer, those are too slow. But you can do the CNBC stuff. You can also check Twitter trends and so on. But you don't see a lot of exuberance out there. There are places, I guess people will go crazy about Bitcoin one way or the other, but it does not look like there are broad-based bubbles going on, except maybe in Nordic housing markets, but that's another issue.
We have one question: where could Europe have been today if we didn't respond to the 2008 crisis with the policy of austerity?
Well, I would say there was going to be some austerity. That had even people like myself don't think that you could have had fiscal stimulus as policy. There was going to have to be some austerity in Southern Europe. The question is whether, let's say, Spain could have had less severe austerity. I would argue that if Spain had not been pushed into tightening as much as it has, or Italy into tightening as much as it has, that they would be still adjusting. That we would have almost as much internal devaluation in Spain as we've had, and a not much worse debt ratio. If the austerity policy had been less severe, that Spain could have had 20% unemployment instead of 27% unemployment. And that just the level of misery would be less. That Greece would be more or less, Greece would arguably even be, if they had had austerity that was 8% of GDP instead of 13% of GDP, that they would be pretty much where they are now in terms of debt and interest rates, but with less horror in terms of daily life. So that's really all you can say. Not that you could get away without it, and not that things would be good, but that they wouldn't be quite as bad.
But are these the PIIGS countries? Are they sort of in the same situation, or would some of them be better off leaving the euro?
That's an interesting.
It's actually my own question, but
yeah.
I used one of the questions to
So there are two different questions here. No, one is whether they'd be better off if they had never joined the euro, which and I think you can argue probably all of them would be better off if they had never joined. But getting out is an extremely difficult process. In fact, we're not. There's no provision in the law for it. It creates a huge disruption along the way, and it's basically inconceivable unless you have a banking crisis first. You have to shut the banks, and so now we are now at the point where several of the countries have primary budget surpluses, which means that they no longer, if they stop paying their debts and drop out of the euro, they don't face an immediate need for financing, but you still have all of the disruption. I would argue, let's put it this way, if I were advising any of the governments, I would probably say no. Even though it's terrible, I wouldn't do it because the costs at this point are just so very large. But it's interesting, when I've tried to figure out who actually has the best economic case for leaving the euro right now, it actually would be Italy. Primary budget surplus, pretty big, not that dependent upon the rest of the euro area, but it's not going to happen. Actually, somebody once told me that the best way to view the euro is it's a plot by the Italians to have German central bankers. The whole thing. If you look at the story, and of course they ended up with an Italian central banker. But anyway, so they're afraid of themselves, and so they won't do it. But if on the sheer economics, Italy would be the one that would almost certainly be in a significantly easier position if they weren't part of this thing.
But they have the problem that they had like 61 different governments since
the
Second World War.
No, that's right. Italy their problem has been that they don't trust their own politicians for good reason, and but the trouble is that you can have sensible, responsible, stern central bankers who, for all the right reasons, actually do you a lot of economic damage, and that's what's actually happened to Italy.
But great food. Absolutely.
No, Italy.
It's a great country.
That's right. No, and a great country which has now had actually Italy's economic stagnation since 2000 has been much worse than Japan's. So if you want to ask about who's a real model for things going wrong, it's the Japanese actually are heroes of economic growth compared with the Italians.
I have one question about the inequality that's increasing, especially in the U.S. and what impact would it have on demand on the overall economic growth, the increasing inequality?
Okay, so that's each of these questions leads into, as some people know, a large discussion and a debate. So the impact of inequality, the extent to which inequality is responsible for secular stagnation, is highly contentious, and it's contentious among people who usually agree about things. So I'm skeptical. I don't fully buy the notion that it's inequality. I think it's not clear that higher inequality has depressed consumption. Maybe it has, but it's not at all clear from the data. It's not compelling. Europe, with lower levels of inequality, essentially had the same financial crisis the United States had. But there is a case to be made on the other side. And what's interesting is that Joseph Stiglitz and I have ended up arguing with each other on this. And obviously, I take anything that Joe Stiglitz says very seriously. So it's an open question. I would say that the reasons to say we need to tackle inequality in the United States aren't primarily because it'll help us on the business cycle. You want to do that for other reasons. But there is an argument. You can go back and forth on its role in the current situation.
So it's more an ethical question than an economical question.
Well, I would say it's long-term economic growth, actually, as opposed to short-term. There is a real issue. If you have the levels of inequality that we have in the United States, it really blocks, the gap between the classes is so large that talented young people who are born to the wrong parents never get a chance to express those talents. And so we are effectively wasting a lot of potential. I think we are definitely at the point where high inequality is negatively affecting our long-term growth. Whether it's having an effect on keeping us depressed right now is less clear. But no, I think, so it's not just ethical, it's also practical. We would be a richer country overall if we had less inequality.
Yes, so it's the people resources that are really bound by...
It's the human resources.
Yeah. I think we actually have time for a question. When we are now finally entering into this, not bubble, but this very special country of Norway.
Yeah.
And what are the biggest faults with the way Norway is run? By your opinion?
I've spent some time, not an expert, but I've tried to do my homework and then forgot entirely to talk about it here, but that's okay. Probably because I'm nervous on the subject, so I have an excuse. There's not an obvious wrongness in, Norwegian policy, I'm sure you can fault in detail. The broad idea of trying to wall off the oil money is the right thing. The idea of accumulating the retirement fund, which isn't a retirement fund, but anyway, a sovereign wealth fund is good policy. It's been really fortunate, I think, to have the independent currency. That the oil would be really distorting and I think dangerous if you were actually part of the euro area, because it would lead to inflation that would then, when the oil ran out, would be very difficult to reverse. So the overall picture is pretty decent. You take a look, so obviously Norwegian house prices are now, that's the biggest rise in the world as far as I can tell. And there are some reasons for it. Effectively, Norwegian households are much wealthier once they take into account the implied wealth from the retirement fund. But it's still kind of alarming. But I'm not sure what exactly one would do about that. I don't have a lot of criticism of Norwegian policy. I'm sure I'm missing something. I'm sure there's something terrible I don't know about. But from the outside, it doesn't look so that there's any really glaring fault. I mean, you don't have idiots dictating policy the way that so much of the rest of the world has.
And the last question about China. Yeah. Will they manage to maintain the high growth?
No. I mean, that's obvious. They can't. Even if they do everything right, no. China's had high growth by maintaining not just, first of all, by massive transfers of labor from a highly unproductive agricultural sector into the urban sector. They're running out of peasants, so they can't keep on doing that. By maintaining not just high, but ever-rising rates of investment, which they cannot continue to do. Their investment is already a crazy share of GDP. So they are, and also by, to some extent, by borrowing technologies, and although they're still well behind the cutting edge, they're not as far behind as possible. So everything is pointing to a sharp decline in underlying growth. I don't think the question is whether Chinese growth slows a lot. The question is whether the slowdown in growth is orderly or disorderly. And the chances look quite high of it being disorderly, that they will be unable to sustain the levels of investment, partly because at this point they're being sustained by rapidly rising debt, but that there won't be other sources of demand to step up and take the place of the investment. So China, to me, looks in many ways like Japan in the late 1980s. High investment, declining trade surplus, excessive credit growth, and in effect a bubble ready to pop. And so China may join all of the rest of us in secular stagnation in the near future.
And there's obviously a derivative question on that, and how will this affect us? Europe?
Not so big. China, in terms of spillovers, you want to measure China not at purchasing power, but in dollar or euro value. And in those terms, it's an economy that still is only a little bit larger than Japan. So China is just not that big a player in world demand for it to be a big deal. It's not. The reason it's obvious if you're in that neighborhood, if you're a South Korean exporter, you're going to worry a lot about what's happening to China. But I don't think it's a big deal for most of Europe.
And I think we would of course, thank you for coming and end on the notion or your quote that we don't have a lot of idiots in Norway. I think that's a nice way.
That's right. That's a very big, very important thing.
Thank you very much.
Thanks.